Hello, everyone. If you're invested in silver, this has probably been a pretty brutal week. The price just hit a new post-crash low of $64. And look, it's completely understandable if you're feeling exhausted, confused, maybe even a little angry. So in this explainer, we're going to break down exactly what is happening and, more importantly, why. And the thing is, this new low happened without any new bad news, right? There was no surprise announcement from the Fed, no new geopolitical crisis. And yet, here we are, at a price lower than anything we saw during the initial crash. If you're holding paper silver right now, I know that pattern is just exhausting. It bounces, you feel a little bit of relief, and then it drops again even harder. It's confusing, and it's draining. All right, let's get right into it. But first, just the standard disclaimer. We're analyzing market mechanics here, not giving financial advice. So please always do your own homework. Okay, a real quick bit of context. If you remember from our last explainer, we talked about the price vector model. The whole idea is that silver's price is really a balance between three big hubs: the paper contracts in New York, the physical benchmark in London, and industrial demand over in Shanghai. What we've been seeing is the New York hub breaking, and so far, the attempts to fix it just haven't worked. And there is a very specific mechanism behind that failure. It's something we call a margin ratchet. And it is the engine driving these aftershocks we're all feeling. So what does this margin ratchet actually look like in practice? Well, to really get it, let's just walk through the last 4 days, step by step. It's the best way to see exactly how this recovery fell apart. So you can see it all started on Monday, February 2nd. Silver dipped to $71. And on that very same day, the CME exchange raised its margin requirements from 11% to 15%. Now that is a huge 36% jump in the collateral you need to hold a position, overnight. Then on Tuesday and Wednesday, it looked like we were getting a bounce. The price climbed all the way from those lows to $92, and the spreads between New York and London started to narrow. This is what a recovery was supposed to look like. But then Thursday happened. It all just fell apart. The price collapsed from that $92 peak all the way down to $64, a brand new low way below the crash day itself. Now, here's what's really telling. Let's compare this to gold. Yeah, gold sold off this week too, but only by about 10%. Silver, on the other hand, dropped a staggering 4 times that much. We actually saw the gold to silver ratio, which is a really key metric, just blow out from 57 to 67. So yeah, there are definitely bigger macro headwinds out there. But the crucial point to take away from this is that silver's extra damage, that massive underperformance, is coming from inside its own leverage structure. So we know the damage is internal. And that brings us right back to the core mechanism here, the margin ratchet. Let's break down exactly how this engine of aftershocks really works. It's basically a self-reinforcing loop, a vicious cycle. First, you get a sharp price drop. Then, in response, the exchange raises the margin, that's the deposit you need to hold a futures position, to protect itself. Now, any trader who can't come up with that extra cash is forced to sell their position. And that wave of forced selling, well, it pushes prices even lower, which can then trigger the exchange to raise margins again, and the whole cycle just repeats itself. And believe me, this is not a small adjustment. Before the crash, margins were sitting around 11%. On February 2nd, the CME hiked them to 15%. Then, on February 6th, they did it again, raising them to 18%. That is a 64% increase in the collateral you need in a single week. And this slide just perfectly illustrates where all the stress is being concentrated. While the CME's in New York is desperately tightening its requirements, trying to protect the system, China's Shanghai Gold Exchange actually did the opposite. They lowered their margins from 26 down to 23% to keep trading orderly. All of the stress is being absorbed by that New York paper market. So at this point, you're probably thinking, okay, fine, but I only own an ETF like SLV or PSLV. I don't trade futures. Why does any of this affect me? And that is a critical question. And the answer is pretty simple. The futures market sets the reference price for your ETF. So when those forced sellers are dumping futures contracts, that price action feeds directly into your fund's valuation. No, you won't get a margin call, but you are absolutely writing the exact same price tape. Your fund's value gets dragged down right along with it. So with all this turbulence, how do we know when things are actually starting to calm down? Well, here's an updated version of our pilot's checklist with 5 key signals to watch for any signs of stability. Okay, first and most important, number 1 on the list. Margins stay flat. If the CME holds steady at 18% and just stops hiking, that forced selling cycle loses its fuel. Second, we need to see no new low after a margin day. That February 6th hike is the next big test. If prices can absorb that without breaking, the ratchet might be slowing down. Third, volatility needs to start trending down, and I don't just mean one quiet day, but a sustained drop in those daily price swings. Fourth, spreads need to stay tight. That means the gap between New York and London and the discount on ETFs like SLV. If those start widening again, it's a sign the aftershocks aren't over. And finally, number 5, Shanghai has to reopen cleanly on February 24th after their holiday. That's a whole week with a major price node offline. So the question is, does it reopen at a premium, or does it converge down to wherever New York has drifted? Okay, so that's the checklist. Now let's move on and see how this all kind of builds into a forecast. And I want to be really clear here. These are subjective weights, kind of like a pilot's weather briefing. They're a framework for thinking, not for trading. So in the next 2 weeks, the bias feels down and unstable. I'd put about a 45% chance on the aftershock slowing down and the price consolidating somewhere between $55 and $80. But there's a pretty significant 40% chance the ratchet keeps running and we see prices below 55. Over 1 month, the big event is Shanghai's reopening. That leads to a really wide normalization range of $55 to $90 as my base case. And then looking at a full year, well, this margin ratchet has exposed a real fragility in the paper market, so the ranges are wide. The base case is a very broad 55 to 120, with about a 30% chance of a structural repricing above 160 and an equal 30% chance that macro pressure pushes us below 45. As you can see, the uncertainty is really high right now. So the crucial point, the one thing to really take away is this. New lows without new news, that is the signature of an aftershock regime. The market is not crashing because of some fresh piece of bad news. It's crashing because the forced cleanup of leverage simply isn't finished yet. And I do want to end on a personal note. I know this has been a really, really tough week. If you're watching this and your portfolio is hurting, please know that you are not alone in that. A lot of people are in the exact same spot right now. The one thing I would offer is this. Try to separate what this mechanical ratchet is doing to prices from what you fundamentally believe about the metal long term. Those are two very different things. The ratchet, it's just a machine. It runs until it runs out of fuel. Take care of yourselves.